evening, everyone. I'm Ghazal Jain, and I'm delighted to welcome you to Certainty in an Uncertain World, Elections, Economy and Returns, an exclusive webinar. Joining me today are Mr. Ajit Dayal and Mr. Christy Mathai. With over 35 years of experience managing assets to the tune of over $2.4 billion, Ajit is the visionary behind Quantum. Christy is the fund manager of Quantum Long-Term Equity Value Fund and Quantum ELSS Tax Saver Fund. Thank you, Ajit and Christy, for being here today. They say the only thing we can count on is uncertainty.
Thank you, Ghazal.
And you would agree with me when I say that uncertainties in today's investment environment are plenty. We have a flurry of global elections in 2024, where representation for nearly half the world's population and GDP will be on the line. Russia and Ukraine have been at war for close to 2 years, and now the conflict in the Middle East threatens to add fresh vulnerabilities to the geopolitical and energy situation. Global central banks are on a wait-and-watch mode, keeping interest rates at multi-decade highs and markets on their toes. Domestic fundamentals look constructive, but is the best behind us? We will be discussing all this and more today with Ajit and Christy as they help us to understand how we can navigate this dynamic terrain and build an impactful equity portfolio with predictable outcomes. I encourage you to ask questions on the chat, which I will take up with the speakers after the presentation. And now I will request Ajit and Christy to take over.
Ghazal, hi, thank you very much, and thank you everyone for joining in. As was set the pace by Ghazal with all those question marks out there, we are looking at an increasingly uncertain world, and how do we find certainty? I just want to go back a bit to what Quantum has done in terms of making sure that people understand that we're not a fund house that manufactures funds for the sake of manufacturing funds. We've done it in a very deliberate manner. There's a triangle up on the screen, which shows risk and return. At the base of the triangle is the lowest risk asset class, which in our case is a quantum liquid fund that only buys bonds issued by the government of India and quasi-government institutions, PSUs. And at the tip of this in the green would be crypto and whatever else you want to do, which is high risk and unknown returns. And in the middle, Quantum operates by having, say, gold is a steady long-term asset class, and then equity, which is what we circled, the Quantum Long-Term Equity Value Fund. So the blues are within the dark blue. We believe we have a very predictable process for figuring out how and how much money you can make by being a long-term investor. Let's take a flashback to September, October, November 2008. Lehman goes bankrupt, and the G20 leaders pictured here, at that time, President George Bush was still the president, although he lost the election to Obama, who was the president in waiting. And from 2008 onwards, from September of 2008 onwards, central bankers, government leaders, finance ministers, economists, everyone met to sort of figure out what's going on in the world and how bad things are. And at that point in time, the process that we built for identifying stocks in the Quantum Long-Term Value Fund made us come out with a very crystal clear prediction. So you're November 2008, the world is sort of falling apart. And here is Quantum telling you that if you are an investor, and we could see this data, if you're an investor in the Quantum Long-Term Value Fund, you will make this absurd rate of return of 170% by November 2010, 2 years, if you're patient. And this is what we actually did. So the projection was 153, and we did a little better than the projection. And so the orange line is the projection, the blue is what actually happened. And these were the returns that we delivered those who were investors. And was that a fluke? Well, let's look at COVID. March 2020, humanity is coming, locked down at home, no one on the streets, and presidents, prime ministers don't quite know what's happening. And stock markets, of course, are falling. And here again, the process that we built for identifying stocks and building a portfolio in the Quantum Long-Term Value Equity Fund told us, indicated to us, that if you stayed patiently as an investor, and if you were not around because you got hit by COVID, your heirs, your successors would see an upside potential over the next 2 years. And this is what we actually delivered. So we fell a bit short. Apologies for that. We indicated to you we'd make 113% return if you were an investor from March 2020 till March 2022. And we were a little off that, a few percentage points below that. But that's the power that in these crises, when the world is so uncertain about what's going on, we have built a fund, a long-term equity value fund, which we calculate what we call the upside potential, the amount of profit you're likely to see in the appreciation of the NAV 2 years in the future. It's a monthly 2-year rolling number. So I'll go back in history. The fund was, of course, launched in 2006 March. So we started making forecasts looking out, as you can see. And you saw those sharp forecasts that came out at the time of GFC and the time of COVID. That's the orange line. And this, the blue line, is what we delivered. So as you can see, again, we missed out a bit because of what happened during Lehman. On the extreme left, the blue line, you lost money if you came to meet us in 2006 September. 2008 September, you were minus, as was the whole world. And same thing with COVID. You came to meet us in March 2018. By 2020 March, you were losing money. But of course, if you stayed with us, and we gave you these, an investor in the fund would have made a fair amount of money. And this is like a long-term thing. We've always heard Warren Buffett talk about the power of compounding. So an investor with us since inception would have made roughly 13.8% rate of return if they stayed with us right through now. And that's what we expected. And what we delivered after fees and expenses, the net asset value was 14%, 14.0%. So a little more than what we thought we would make on each month going forward. And these are the two lines together. These are like nominal NAV values rebased to 100. So you would have made roughly 10x your capital if you stayed with Quantum Long-Term Value Fund since inception right through. So that's what we do. We pick stocks, we identify companies we like, and we build a portfolio with a very predictable rate of return, which is probably what no other fund manager in India does, and probably no other fund manager in the world does. I can say that with a lot of confidence. I took these slides to a bunch of investors around the world a few months ago, and I showed it to them, and they were impressed. They said, we've never met any manager who has made a forecast in equity markets in any country and then shows us what the rates of returns are. And again, this is the SEBI disclaimer. Past performance may or may not be sustained in the future. We're not even talking about past performance. We're trying to estimate the future value of the NAV of the fund. So very different. When the team of analysts and when fund buyers, they meet the management, they visit the factories, they do everything. When they do that, they estimate the intrinsic value of the company. So let's say we think 2 years out, the intrinsic value of a company is rupees 100. The process tells us that we can only buy a stock if it's at a 25% discount to that intrinsic value, i.e. at 75 rupees. So if we're right in our research, the 75 becomes 100. That's a profit of 25 and a time horizon, which roughly is 15.5% per annum compounded. That's the rate of return we should get. And as I indicated, what we have delivered since inception is a rate of return of 14.1% after fees. and our costs have been roughly 1.6%, the historical long-term average of the value fund's expense ratio. So if you were to add that to, you'll get the 15.7. But of course, now the expense ratio is lower at 1.1, and Quantum has already indicated since 2017 that as AUM increases, it will drop its fees and expense ratios. So we've done, pretty well in terms of prediction. We've done very well to show across cycles. We've been able to predict and forecast and estimate what the NAV is likely to be. And that's, pretty impressive. When I was managing money for Vanguard, for the Vanguard International Value Fund, from 1999 to 2004, one of the key questions I asked Vanguard is how do they select an external manager to manage some of the money which they do in-house on the active platform, where Vanguard is known for index, it's known for ETF, but it also has a pool of money for active managers. So picking stocks is active management. And they spoke to me about the 4Ps, that who are the people behind the firm. In our case, that's me and Subbu. What's the philosophy? Long-term value investing. Sensible returns is the outcome. And we have an integrity screen to sift out bad actors and bad managements from that portfolio, which we build on your behalf. And then, of course, what is the research and investment process? So you say you're a value investor. Well, how do you prove it? How do you find companies? How do you build a portfolio that has value characteristics to it? And finally, the predictability of the performance. And I just showed you. Vanguard was giving me a directional trend line. We've mastered what Vanguard taught us and made it into a point line, a point in forecast, been around for a long time. 1990, we set up India's first institutional equity research company. In fact, it was 34 years and a week ago. Subbu joined Quantum in 1996. And that's the year we also introduced this integrity screen to sift out the bad actors who exist in most countries, but certainly in the Indian market cap space too. And by 2006, on the extreme right, we launched the Quantum Mutual Fund brand in India. We've been pioneers. We've set the role for transparency. So not only do we understand how to manage money, we took global partners we had to heart, and we said, let's build the finest investment firm, which happens to be based in India. So we set forward for SEBI to follow, strangely enough. SEBI, things that we started, SEBI 3 years later, 10 years later, one of them is still outstanding. They've made it to law for the fund industry. So unlike the big, large branded fund houses who get dragged into reform, Quantum has had a very pioneer. Let me quickly move to the topic about uncertainty and the fact that, of course, in a couple of months, we should be having yet another historic election in the great democracy of India. And we're awaiting the judgment of the voters, though most of us already assume what the outcome is going to be. Let's look at a couple of governments in the past in terms of what have they done, what sort of policies have they come out with, what did that do to GDP while those governments were in power, and what happened to stock market returns in that period. The reason I put this slide up there is just to recognize that not everything is done on the extreme left, not everything was done in the middle, and not everything done on the extreme right. It's some sort of a continuation that's happened. And technology, time, and good leadership have accelerated different parts of these attempts to make India a more market-driven and certainly a more vibrant and wealthier economy. And let's go back even further from 1980, and let's look across 11 governments, and let's see the GDP while each government was in power. So on the x-axis at the bottom of the screen, you'll find things written in black or red. Black indicates single-party governments. The orange bar is GDP growth rate while that government was in power. And the blue bar is GDP growth rate of the world. And the red on the x-axis is coalition governments. And if you were to eyeball this slide, you get a couple of things that come out of that come jumping at you. One is that whenever there are single party governments, GDP tends to grow less than the long term average, which is there, less than the long term average. And if you look at coalition governments in the red, GDP tends to be higher than they were under single party governments. Recognize that in the May 2019 NDA asterisk on the right side, we have two numbers, a 7.4 number and a 5.9% real rate of growth of GDP number. Recognize that there was a change in the way GDP was reported. So if you adjust for that change, and roughly economists believe 1.5% is the right number to adjust, there's no conclusion on that. The 7.4 minus the 1.5% adjustment, because the base of calculations changed, would have given you a 5.9% under the old series of GDP calculation. And the reason we have the extreme two right points of the NDA, May 2019 and September 2023, the reason we have them as individual, sort of in black, single party government is because although the BJP has actually won as a coalition, it really runs the government as a single party. So it's not really a coalition in spirit. It may be a coalition because it's the NDA has won, but really the BJP on its own has a majority, and the BJP really runs the economy in that sense. In this slide, we've added one row at the bottom just to talk about the rates of return of the index in dollar terms while each government was in power. So here again, you can see it's not necessarily true that single party governments give you more higher returns. It's not the best returns when you compare them to other governments. But it is, of course, important to note that India is doing extremely well as an economy, and India is doing extremely well as a stock market. So here we've tracked since 2003. In the blue line, we've tracked India's nominal GDP, taken it in a linear equation with a base of 2003. And we've taken the Sensex total returns, where dividends are reinvested and put back into the market. And you can see this fabulous correlation that GDP growth rate enhances revenues, activities, and profits in a country, and also enhances stock market returns, as you can see from the orange line of the Sensex. In terms of what exactly happens around elections, you can see from this data point that it really doesn't matter too much in terms of whether elections sort of come and go, governments come and go. But one thing that you will see that stand out is that the Quantum Long-Term Value Fund, we just taken time points over here, has done fairly well a few months after elections. And if you look at the last few rows also, even over a 3-year time period, it has done sometimes better, but over longer periods of time, the long-term value fund has done better than short-term movements that may exist within the index. And you can see that, in other data, if you look at 1-month data, you'll see that also in other slides that will show you going into this presentation. I'll quickly just show this one slide about the fact that the value fund has done better than the main benchmark is the S&P 500. And then, of course, the BSE 30 total return index, where dividends are reinvested. And there's also BSE 200 index with total returns reinvested there. So we've done better over a long period of time. With that, I'm going to turn over to Christy, if I may, to
sure.
talk a bit about why you should stay on in the Quantum Long-Term Value Fund. Then we'll come back to talk more about uncertainty. Thank you, Christy.
Thanks, Ajit, for laying that. So we're just going to be looking at some of the drivers of the markets and some of the macro condition that India is in with respect to the world at large. So coming to the major drivers of the market, if you were to broadly look at it, one is, of course, valuations and the other is earnings. So if you were to look at, this is a fairly long-term chart from 2007. The brown line shows the broader Sensex valuations at various points in time. And what you see is, by no stretch of imagination, the Sensex is, cheap by now. It is, moderately valued, or, more aggressively valued in that sense. But if you were to really look at the quantum long term, which is the darker brown, line, we always, true to our mandate, we being a value fund, we are always cheaper with respect to broader benchmarks. But this valuation also has a context which is of that of earnings. So if you were to look at this slide, which is broadly the consensus numbers around the earnings for the index. So let's say at the start of every year, the sell side analyst are trying to estimate what would individual company do in terms of their earnings. So they are trying to arrive at a number, what that number would be end of the year. So let's say that's 100, and you aggregate it for all the companies within the index. That's how you arrive at a broader index earnings estimate. So what you see from FY14 to 20 is, there have been a consistent downgrade from each year, and that is broadly what is being reflected in the economy at large. That is, the growth was kind of stalling, or it was not happening. And if you were to just look at the point to point returns from FY14 to 20, it would be single digits at best, the early teens. So not much growth. But the market kept on, going up, which is shown, in the background chart. Uh, in the current environment, what we are seeing is, of course, the earnings have, FY23 was the first year where the earnings estimate, came in line or slightly above what were estimated by the analyst. And you see FY24 and FY25, there have been significant upgrades. So the valuations that we see in the present context, which is high, is also undergirded by the earnings growth, which we are seeing in the economy at large. So broadly, FY15 to 20 was that phase of an economy where growth was slower, the economy was not doing so well, but we are some sort of in an economic upcycle in that way, which is a natural course of how an economy behaves over various cycles. Now, just coming to some of the macros and how India is positioned. So this is a fairly long-term chart, dating back almost 550 years. So this is India's contribution to the world GDP. And if you were to see, the early years, India was a significant contributor, upwards of 20-25%. But, that number had really shrunk down in 2015, it was around 7% PPP basis. But if you were to look at all projections by various, global economists, India will have a significant share, come 2050, along with China. But the key question to ask is, does this economic growth really translate to, returns for an investor? And that is what is shown in this chart. So if you look at China nominal GDP, that has been fairly steep growth, but that is not really translated into, any growth for an equity investor. But unlike that, India is an opposite case. And, I used to be tracking some of the stocks in China, namely the best private technology companies like Tencent, Baidu, and they were fantastic businesses, virtual monopolies, because, the economy was like that. But government decides that they want to just disrupt everything. And that is what you see, absolute lack of confidence in that economy at large and the equity investments. So India is clearly a different case. This number is 2000 per capita is really spoken about. And this is somewhere where people expect the J curve in terms of economic growth to actually happen. India has crossed it. India somewhere around 2500 per capita income now. And so what really happens at this point in time, you're essentially moving away from the very basic subsistence level survival to, more, consumption, more discretionary consumption. And that is what drives, the growth in most of these geographies. Some countries, as you see, when they cross this particular 2000 kind of dollar barrier, you see growth acceleration in most of these economies. And same is true with what will happen in India as well. This is a pretty interesting slide. On the left-hand side, you see export of goods. Now, traditionally, if you were to look at export of good composition, in 2020, from 2020 to 2023, there has been almost a $150 billion jump in the export of goods. Now, 75%, almost 50% of this is linked to crude, crude related products, petroleum products, refined products, refinery products, where you are kind of, ramping up refinery capacities, and crude price impact also, plays a role. But the other 50% is pure, manufacturing goods, which has kind of taken off in India. And this is a big change that we have seen in the past. And while at the present condition, these not may not be very value added, because the margins are perhaps lower in this case, or you are not, capturing the entire value as, of the export that you're doing. But suffice to say, this is a big number. But more importantly, what you see is the slide on the right, chart on the right, which is the export of services. Now, traditionally, India, services exports majority used to be comprising of Indian IT services. You have a bulk of pharma also doing that. But we see an emergence of, global capacity centers ever since COVID came in. That's the time where bulk of the world realized that, we have to outsource not only IT services, which, is being outsourced in a big way, but we also need to sort of set up back offices in India, because you have the technology talent here, as well as, there is all sorts of back offices being set up, be it for law, be it in pharma space, and so on and so forth. Now, this will move a needle in terms of economic growth, because these are fairly high paying jobs. So if you were to look at the total Indian IT services employee base, that's roughly around 4.5 million, employees working in Indian IT services, the traditional IT firms like TCS, Infosys, and so on and so forth. The GCC, the employee count is close to about 1.8 million. And it used to be around 1.2 million start of 2019. So there is a massive jump that we have seen in this global capacity centers hiring. And these are large campuses, like, the likes of JP Morgan have close to 40,000 employees. BOFA has close to 25,000 employees. So this, and the, the employee compensation is much higher than what you have in IT services. So this also, as India picks up, now the number touted is close to about 4 million in GCC, from 1.8 over a next near about 6 to 7 years. So this will also move the needle in terms of economic discretionary growth. And for the first time, what you're seeing is the services exports actually higher than the oil imports. And this will go a long way in reducing our dependence. Our CAD and so on and so forth would be in perfect shape if this exports services growth were to catch up, in the coming years. What you're seeing is there is, infra development, but India is witnessing infra development over a very long period of time, and in the recent years there has just hastened. But in terms of global competitiveness, India still lags behind the likes of China, where they have created massive capacities. So while there is improvement, more needs to be done to be, globally competitive, especially in the exports phase. This very important slide, if you were to, from broader economic point of view, that is, the supply and demand actually are finally coming, it's very well matched in our view. If you were to look at any corporate, before the COVID, what we have seen is most of them were highly leveraged, and there was no capex investment. Many of them were like, what we have saw in many bankruptcies during that period also. But post this COVID, especially coming to FY 22-23, what we have seen is most of the corporate balance sheet have kind of cleaned up. And what we have also seen, the profitability of most of the firms who have survived has kind of improved. And that is shown by, the top and right side chart. Now, if you come to an entrepreneur, who wants to grow his business, assuming there is significant demand, so he is now in a position to be able to take debt and to grow his, and to put up capacities, because he is going to earn higher ROAs or ROEs as he looks at, his investment. And on the supply side, if you were to look at the whole banking system, it has gone through a big change, right? The whole NPA, forced NPA recognition, during the Raghuram Rajan era, has kind of resulted in the system level NPAs really coming down. And COVID was an important point, because you see most of the banks kind of going up in terms of capital adequacy, because a lot of them raised money, they cleaned up their books. Now, if an entrepreneur wants debt, because you can, so everything cannot be equity financed or internally funded. they would come to a bank for a corporate loan, and the banks are in the best of shape to be able to lend to these corporates. So somehow the supply and demand is kind of getting fixed, which is a big change what we are seeing in the recent past. And all this boils down to, in terms of flows, what we have seen in the last so many years with a fairly long-term chart, that the FDI and FPI flows, there have been an inordinate amount of money that has flown to China. With all these macros in our favor, there is a possible reversal that can happen. We don't know the scale of that, what can happen, but India should command in that sense a higher share of foreign portfolio investment as well as FDI going ahead. And if you were to look at our currency, it's been fairly over a long period of time, while there's been depreciation, and 2% depreciation is what is kind of assumed, we are in fairly good shape. It should not move, beyond a certain range, even come what may in terms of global macros. I think this is also very important chart in terms of the real estate sector revival. We are all reading about the luxury home sales that has just taken off in the recent past, especially post COVID. While there were certain supply side issues that were getting sorted, be it developer consolidation, there were some tax breaks and so on and so forth. But I think what will really move is the affordability part, right? In 2020, if you were to take buy a house in Mumbai, let's say of the 100 rupees of your monthly earnings, if you were to assume it's 100, almost 93 rupees was supposed to be paid as EMIs. So, no wonder, the affordability was so low back then. But given a time correction in terms of prices, in some markets, there have been a significant correction in terms of prices as well. And the overall improvement in the salary levels, what we've seen is that the affordability across the board in most markets have kind of improved. That is also kind of leading to real estate sales, and we are kind of probably in the third year we are seeing of the cycle taking shape. So this, if you want to roughly compute so there is no real estimates, but like the real estate market can be roughly 6 to 7 to 8% in terms of GDP contribution. And if this were to move, which did not happen in the last 10 years, so there could be a significant contribution to the economy as a whole. And lastly, what we are seeing is there is a inflation in the system is across the board is coming down. What we are seeing in the core CPI, which removes the vegetable prices, is also kind of coming down. And what we are seeing is most of the Indian corporates has seen a margin expansion because some of these cost pressures which were really hitting them in terms of margins are really coming down. So inflation in that sense is coming down for the system as a whole. Right. I'll just pass it on to Ajit to take it forward from here.
Thank you, Christy. I'm just going to go back again to the, to where we end off. So, we sort of began with a course of talking about how the quantum process for the value fund is very predictive. How we go to meet companies, we try to understand their intrinsic value, meeting managements, visiting factories, customers, and then how we achieved having forecasted an upside potential for each stock and for the entire portfolio. We then went on to forecast how we actually are able to reach that number. And, as Christy spoke about in his presentation, we've got the macro wins behind us. We do have an India that is moving and has been moving for a decade or for decades, as we know, for those who remember the Mrs. Gandhi reforms towards NRI, Rajiv Gandhi tax breaks of the 1980s, and you had the big reforms of the 1991 era, and then of course things that have happened since then. So one of the sort of concerns that I think many individuals have is when you are investing in equity, that risk and return relationship, when people get very optimistic, when people get very buoyant, they kind of forget that risk and return, and every equity investor becomes a guru. And those who are disciplined, and those who are structured, and those who are sensible look like fools. You meet your friends and they've rolled the dice on some small cap fund and sort of treble their money in 3 years. And you've got this very methodical approach that's going on. I think the whole idea of a slide, and we had this before, but a different version of the triangle, is that you have to sprinkle your assets across not only different asset classes, but within equity, you have to sprinkle it across different types of equity approaches. And what we are offering in some sense is not something trying to double your money in 1 year or double your money in 2 years. We're looking for a 33% rate of return over 2 years, which is a 15.5% return over each year in the future. And if you look at the NAV of the Quantum Long-Term Value Fund, from rupees 10 to over 100 over 17 years, it's given you roughly 14% and change, because there are expense ratios to get that rate of return. So we've achieved what we're supposed to achieve. And that doesn't stop you from putting some of your equity risk money into different products, whether it may be our ESG fund, or whether it could be a small cap fund, or whether it could be private equity or venture capital. The whole idea of risk and return is to have asset allocation. For those who joined in early, you heard the presentation and the song and the jingle of Bara Bisanasi. So that is the framework under which you operate. But recognize the beauty and the elegance of what's been built and is being presented to you. Something with a 17-year track record, something which distributors are not very keen on pushing, something which wealth advisors also may have their own calculation of alpha and consistency and risk return. We've got, in our view, in my personal view for sure, we've got a phenomenal product where we are showing you a prediction across every global environment, whether Ben Bernanke wanted to raise interest rates in 2012-13 and caused a twist in the US dollar to surge and the rupee to fall, and Raghuram Rajan had to raise interest rates at that time to prevent the rupee from falling further, or whether it was the ILF's bankruptcy, or whether it was value versus growth, where Paytms and Nikers did much better than boring cement and steel and other such value stocks. And also, we worked in an environment where there are, certain corporate tycoons who move on government favor. We don't own those stocks. So we take away risk in many ways, and we give you this very, very steady return from this disciplined approach that we've got, from this approach of meeting companies, meeting managements, making forecasts 5 years out, trying to understand the sector. As Christy said, he used to track companies in China. Why would a person sitting in India investing in Indian stocks track companies in China? It's because we wish to understand the world, to understand what's happening in the sector across the world, and to see if the Indian companies and Indian managements recognize the risks to their business, to their sector in India. So you've got this global tailwind of India being loved, but you also have this very, very disciplined process that Quantum has brought to the table. And I must insist upon reminding you yet again, there's a very unique process where we can predict and deliver. The other element is, if you are a value manager, you're supposed to be buying something which is less expensive than the index. And that's we've achieved. So if we can see, if you look at the P ratio, it is 21% less expensive than the P ratio of the BSE 30. And if you look at the growth of EPS at 13.5%, it's very close to what the growth of EPS of the BSE 30 companies is going to be. And therefore, if you look at the PEG ratio of the product, you're actually able to buy growth at a better valuation because you're buying it cheaper, right? So these are the characteristics, the outcome of the process, the predictability, and this is the portfolio, which is the outcome of the process that we built over the decades. And one of the mistakes that your wealth advisor or a distributor or the rating agencies make is that they have this semi-induced measurement of a fund's performance. How did the fund do in 6 months, in 1 year, in 3 years, in 5 years? Nonsense. The fund is designed to either outperform or underperform under certain characteristics of the market. So there are phases, and these phases don't follow calendar years. Calendar years are man-made. These are market has determined what these phases are. And over the last phases that you can see, and we're going to show you a chart on this, over the last phases that occurred, we've taken a bunch of them, 7 such phases. So say in the bull phase of March 2009 till November 2010, that was one of the arrows going up. The long-term value fund gave a return of 189%, equal to the BSE 500, which has a fair amount of small cap, mid cap in it, much more than the BSE 30 TRI, which is mostly largish caps, and then, of course, more than the BSE 200, which has a blend of large and small caps in it. So we captured the upside, right? That's what you're meant to do as a manager. On the bear phase in column number 2, between November 2010 and December 2011, when the market fell, as you can see, the BSE 500 loaded more with small caps fell more, 31%. The BSE 30 with larger, more established companies fell a little less with 27%. And the BSE 200 with a mixture of the larger BSE 30 stocks and some larger mid caps fell by 30%. But look at what the quantum long-term equity value did. It fell by only 20%. It's designed to do that. It's designed to fall less in an environment where things look bad. The companies with scary balance sheets, scary managements are supposed to fall more. And we've done that phase after phase after phase. There are some phases like now, if you look at the slide number 6, column number 5, we haven't outperformed in column number 5 the way we could have, should have, whichever way you look at it. And there are phases when certain stocks may do very well, and there may be 6 or 7 companies that account for 50–70% of the companies of the index gains, or the small caps are doing very well. And we're not into small caps. We're into companies which are highly liquid portfolios, highly liquid trading volumes, and valuations that make sense. I think very few can argue that now small caps are overpriced in that sense. So there will be certain phases when we will not capture all the upside like in number 5. But typically, and that's why over cycles, we can do better than the index if you want to compare us to the index. Although I don't know whether the index would do well if they had an integrity screen. We have no Ambani, no Adani, no Sterlite, no Vedanta, no SR stocks for a long, long, long time. You take those out of the index, let's see how it does, right? And the other thing, again, different from us, we can estimate the future value. Please call up the people who make the index and ask them to estimate what the index is likely to look like 2 years out. They won't know where to begin because the index itself changes so often, as does our portfolio, but not as often. So the other way to look at things in a sensible manner is what you say on rolling returns. So not 1 year, 3 year, 5 year in terms of calendar year, but okay, if I held this stock for 1 year and how many cycles there were of the 1 year and the 3 years and the 5 years and 10 years, how did the fund do compared to the index? How did the fund do compared to its peers? These are more stable ways of looking at indices and looking at returns of a fund. But again, we don't get that support. We don't get that look through from the distribution channels when we have to reach out to investors to explain that here's a group that can forecast and predict and has delivered a 40 to 15% rate of return year after year after year. And even when we missed it during Lehman or COVID, we caught up with it. So, with that, I'd like to turn back to Ghazal and let Ghazal sort of summarize for us what we've been saying.
Thanks, Ajit. Thanks. It's evident from your presentation that it really comes down to long-term focus and a process-backed approach if one wishes to comfortably navigate the uncertainties of equity investing. Now, I'd like to quickly give our viewers a snapshot of domestic fundamentals. Indian economy is indeed on a strong footing, as Christy spoke in depth. And while we are seeing, capex-led broad-based growth, sustained inflation, could be a cause for concern. Higher rates in the developed world could adversely impact foreign flows into India. But on the optimistic side, domestic investors are expected to continue to provide cushion to markets. And lastly, while market valuations are slightly stretched, broader markets continue to provide opportunities. So, with that snapshot and on that note, Ajit, what in your view are the near-term and long-term risks to this constructive India story?
Yeah, so there are a few. Obviously, you referred to some of them at the beginning, which was about the geopolitical conflict. We don't know about the Fed. Are they going to raise interest rates or keep interest rates steady? When are they going to cut interest rates? That's been the betting. They'll cut by March. The Fed chairman has said that's not going to happen. Within India, we've had this issue about GST and the large getting larger and the small shrinking or getting wiped out, and recognize that it's the smaller companies which create the jobs, not the larger companies. So job creation ends up, or lack of job creation ends up in social instability. So while, yes, we do understand and we do respect and we do reward those companies which understand how to steer through the uncertainties of the past, and they have a track record of doing so, while we love to buy their stock, while we love to look at them, we have to recognize, as COVID and Lehman taught us, that global events can change things, and some Indian events can change things. Let me touch a bit upon why people invest in stock markets. It's a very basic question. The reason why we all invest in stock markets is because economic activity results in companies doing better. Companies have better revenues, companies have better profit margins, they report a better earnings per share, and earnings per share drives share prices. That's the basic 101 of why we invest. And it's the same story for why foreign investors invest around the world. They're investing in those economies higher, and where GDP growth rate translates into stock market returns. So on the left, Christy showed this briefly. On the left, we have China's GDP in black and China's stock market index returns to the MSCI China index in green. And on the right, we have India's GDP in black, and we have Indian stock market returns to the MSCI index in green. Look at the contrast. There's a story being told here. The story is that the thesis I just told you, that GDP growth translates into stock market revenue, into corporate profits, and therefore into stock market returns, that has broken down in China, not just for the last 2 years, but for nearly a decade. And why is it broken down in China? It's broken down because you have a government in China that has become very nationalistic, very powerful, and has the ability to pick up any CEO and put that CEO away. They just pick them up from the street and they're gone. So what sort of, and also a government that can decide who the winners and losers are. If you don't like someone, you can take away their company. Jack Ma, his company is gone, and Financial, gone, right? It's not a Jack Ma company anymore, right? They can take away wealth from an entrepreneur. They can take away wealth from the private sector. They can hand over wealth to their friends. You don't like someone, you take away one airport and give the airport to someone else. You don't like someone's telecom license, take it from one person, give it to someone else. That's what Putin does in Russia. So that to me is sort of a risk. And I'll take the example of Brazil's stock market returns in green. And you can see the track. I mean, there was a directional correlation on the left side on the upwards. GDP is going up, stock markets did well. GDP slowed down in the middle, stock markets went down. But look at it now. In the extreme rise since 2021, GDP is growing and stock markets are not yet convinced, because they're not sure if the government in power, the previous or this government, is going to allow markets to operate in a free market? Or are they going to control who makes the profits? Are they going to decide who their friends are and give the crony capitalists all the profit? And again, look at India on the right, a fantastic one-to-one friend, Mr. Putin. Look at the GDP growth rate of Russia and look at the stock market returns. Dead. You don't want to be a stock market investor in Russia or Brazil or China. Why? Because strong men, powerful leaders can also distort who makes money. And take the example of Turkey, very similar. You have GDP going up, look at stock market returns. All the foreign investors who invested in Russia, in China, in Brazil and Turkey, and look at India. Now you know why they love India. India's got this fantastic correlation. It goes back to that earlier slide of 11 governments moving in one direction towards economic reform, towards economic growth, and by and large, leaving capitalism to the capitalists and not getting involved with crony capitalism. So that's a risk. If you get crony capitalism, you've got a problem. Let's look at some other graphs. These are of the developed world. This is the GDP US in the US, the trend line of GDP, and the trend line of stock market returns. It's grown a lot because when Facebook is not dependent on American GDP to grow, when Indian users use Facebook or European users use Facebook, it's going to grow. And we know that in America, it is the FANGish stocks, the Netflix, the Disneys. These are global companies. They don't just rely upon GDP growth rate in America, they rely upon GDP growth rate in the world, including India, to do well. And those stocks reflect that. And let's look at the UK, right? GDP is sort of struggling along. And kind of now they had Brexit and stock market returns are like dead. Not a place to invest in. So GDP may grow, but no one is very sure what's going to happen to stock market returns given Brexit and given the fact that UK right now is an island in economy and it's isolated. It needs to find trade partners. Let's look at Japan. GDP has been flat, the black line. Stock markets on the extreme left zoomed and came back down. And now again, there's this surge in stock markets, partly because of currency. It's got a strong yen. So if you want to park your currency in a good place against the US dollar, people who are buying the yen. Part of it is the view that now there's a new Japan, unlock value in all these companies that are sitting in a declining economy or a stagnated economy, which are trading at below book value. So that's a valuation play, a valuation unlock story. And look at the story on the right again of India. It's a fantastic story. So India is going to do well. India has done very well. My fear factor is that governments should not meddle in what capitalists do and what business does. And again, I spoke about the job creation earlier on. Again, in India, the big issue is how do you create these 27,700 jobs every day for the next decade? You need to create about 10 million jobs a year for 10 years, because all the young people, the demographic dividend that we speak about, the young people are coming out of university, college, they need jobs and they need good jobs. And in the Western world, take the US, there are 10,000 people retiring every day in America. If you add the entire OECD, Canada, Western Europe, UK, and Australia, New Zealand, there are about 30,000 people retiring every day. And they need pension plans, they need healthcare. So those governments have a different problem. They have elderly people living longer, requiring more care. Now, if you're 90 years old and the government does not send you a pension check, you're not going to take a gun and go and protest in the White House. You're going to roll over and just fade away. You're too weak to fight. If you're 24 years old and you're sitting in big cities or urban areas of India and you don't get a job, you're not going to stay quiet. You're going to be out on the streets protesting. So that is, to some extent, are the concerns on the long run in India. So one is the job creation. Second would be, in my view, not in any order, but just reverse of what I said. Second would be, will governments leave the economy alone or will they meddle? And thirdly, really was about valuation, right? Much as one loves India, much as one thinks India is a great place to put money, there's a certain price that you're willing to pay for stocks and a certain price that you should not be willing to pay for stocks in terms of valuation. So those are the three sort of risks that I would love to highlight. I'm less concerned about macro global stuff because as we've indicated, Quantum has understood over decades of investing how to navigate those risks. The value fund is a star performer in that sense. So I don't worry about that because we find ways to navigate that. But I worry about overall trends in market returns, overall health of the economy, overall health of a society. Those would be things that sort of give me, source of concern. So with that, Ghazal, I'll go back to you in case you have any questions from the audience.
Thank you, Ajit. And thank you, Christy, for that deep dive into QLTVF's process and potential, and as well as the insights on today's macroeconomic scenario. And yes, I have a lot of questions lined up. I think I'll start with you, Christy. So India's market cap to GDP ratio has crossed 100. Does that indicate we're at the cusp of a stock market bubble? And what do you think? How will that shape up?
Right. So clearly, in our view, the valuations are pretty expensive, in the broader indices. If you were to look at the small and mid, as I indicated, in the large cap phase, it's fairly beyond the historical means. But in a way, this, especially in the large cap space, we are seeing fairly good earnings growth, which was non-existent, let's say from 2015 to 2020. So that's the difference here. So we are clearly in a positive upcycle from an economic point of view. And even in such an environment, we're able to find new ideas in that sense. Uh, uh, in certain sectors which are not really looked at much favorably as of now. Uh, but to sum it up, there are clearly risks. It is not undervalued as it used to be, and an investor need to be cognizant. That's why we always advise doing SIPs as opposed to lump sum and so on and so forth. And the risk is much higher in the broader spectrum, be the mid and small. So if you just were to look at our portfolio itself, around 38% is to financials and majority in private banks. If you were to look at private bank valuations now versus what it was 10 years back, it is, you look at some of the large holdings, they're at a decaded low in terms of valuations. So there are clearly pockets where, we are allocated, which remains, in reasonable valuation bands. The other example would be in IT services, where if you were to just look at the near-term numbers, it might look expensive. But if we were to build a normalized growth, which is what we usually do, the valuations would be fine, right? Uh, so that said, the broader markets are expensive. Our portfolio relative to that looks cheaper, and it is undergirded by earnings growth, which was not the case earlier.
Sure. So, Christy, given where valuations are, what do you think is the right course of action at this stage? Is it to, sell and book profits or hold? Like, what is,
Right.
the next step?
Yeah, so we always advocate having, that right asset allocation, which include 20% investment in gold. And depending on, your risk tolerance, you might tweak that, gold allocation as you like. But gold is important in terms of our total asset allocation framework. And also within the equity bucket, we clearly define for you what should be your exposure to mid and small, what should be your exposure to growth bias funds versus value bias fund. So within that framework, you should, I think, stay put, and that will really help the experience from an investing point of view. But booking profits and so on and so forth is an individual call depending upon what your goals are. If something is near term, then probably you should park it safely into a liquid fund. But if you're a long term investor, as Ajit showed from that rolling return chart as well as long term charts, staying invested makes sense.
So if I may just sort of jump on that a little bit, it is individual, that's for sure. I know that right now, I as an individual, am not adding more to my equity allocation because I'm overexposed to equity. If I look at this chart, and in my personal case, I always like to keep 36 months of money in the liquid fund so that it takes care of my 36 months of expenses and then sprinkle the rest above. So in my own case, I've broken that 36 months because I bought a property recently. So I'm trying to refill and rebalance myself. It's a very individual choice. I've told friends of mine who ask me, and I look at their allocations, who don't have anything in equity. So I'm making them buy through an SIP every month, right? Even though we're saying at one stage the market looks expensive, you're just going not trying to time it. So if you've got to invest 100 in the market, just not putting 10 every month. And if the market was to crack in 3 months' time, put more money at the time. Don't put 10, put 20, put 30, whatever it is, depending on the extent of the crack. So it is very individual. And I think there's a wonderful tool on the Quantum website, the 12-20-80, the 12-20-80, which allows investors to ensure that they are not overly dependent on one asset class to ensure that they're building a long-term pool of capital, either for their own retirement or for their children's education or children's marriage, whatever it may be. So I think it's important to just make it very personal and not, but in general, the upside potential where we stand today and where the market stand today and with the valuation today, it's not enticing. It's certainly nowhere close to where it was during Lehman and where it was during COVID. Nowhere close to that. Of course, we can see that in terms of when markets were very inexpensive post-Lehman and post-COVID. It's not inexpensive at all. But the charts that we've shown again on the earnings slides, and as Christy mentioned, corporate India is going to do well. India is going to do well. But the valuations do look a little stretched. So it's individual. I'd say be cautious. And for those people who believe this is a new cycle, this is a new era, I really wish they go back and read history, not historical history from ancestral history, but read 2005, 6, 7, the brick mania. Go back and look at what was written by research analysts, by Goldman Sachs itself on brick, and what people expected. You want to go back and look at 99, 2000, look at the internet era. You want to talk about growth versus value, look at 2017, 18, 19. You want to talk about the great India shining story, the great India resurgent story. We've had many such stories. Look, India is a fantastic place to invest, but anyone who believes it's a one-way street has not understood markets, period. And there's a very famous saying from Sir John Templeton, the late Sir John Templeton, where he says that there are 5 very famous words in the world of investing. 4 of them you hear very loudly. The 5th one is whispered, so no one can hear it. And the words are, this time it's different. That justifies buying shares at any price, no matter what it is, because of this great story, this great thematic. Those are the 4 words. The 5th word is, this time it's different, sucker. And the sucker is spelled very softly because you've got another sucker into the market. You've entrapped another investor who doesn't understand that everything moves through cycles. The cycles can be a century for the economy. It can be decades for a currency. It can be 1 year or 18 months or 5 years for stocks. But there's a cycle to everything in life. And there's definitely a cycle to markets. And people must respect that. And people must understand that. And just because you go to a cocktail party and your friend tells you, oh, I doubled my investments in 1 year in this fund, in small cap fund, I bought this stock and I did that stock. Talk to him after 1 year from now or 2 years from now. And they'll never talk about their losses. Everything is in cycle. And the only way to take care of what your friends are doing is to look the other way when they talk, excuse yourself, say you have to go refill your glass. It'll be a lot cheaper and a lot more healthier for you to have that extra glass of juice or liquor, whatever you want to have, whatever suits your taste. Step away from that crowd and stay with this triangle. Stay with a very sensible, very focused view on how you should allocate your money. Go on the website, play around with the tool. It's fantastic. And on top of that, within the equity space, like I mentioned, there are different styles. what quantum long-term value is telling you is that we've understood what to do in crisis. Not one, which is a fluke, Lehman, but we've done this now through Lehman and COVID. And we've done this now for 17 years, where we've understood the shares we're buying. We've gone to meet the companies, pinch them, met suppliers, gone to see factories, made your 5-year forecast of cash flow, balance sheet, understood the company's history, going back 5 years and 5 years forward, and you've come up with an intrinsic value of 100 rupees, for example, 2 years out. And you've only buying the stock in a disciplined way if it's 25% or more cheaper than the 100, at 75 or less. And you're looking for a rate of return that is 15.5% compounded without the cost. You take away the expense ratios, it's 14.5%. That's exactly what we're trying to do, nothing else. And if that number is not exciting for a portion of your portfolio, then certainly you're not a thoughtful investor in the quantum dictionary in the way of things. So sorry, I went a bit beyond, but I want to emphasize on that in terms of valuation and how to allocate capital.
Thanks, Ajit. I think with that answer, you addressed a question we had on, the current euphoria in equity markets and how investors who prioritize asset allocation, feel like they're missing out. So thanks for that. The next question for you is that while Quantum's integrity screen is, very commendable, and it's something we really look up to. There are some other funds that also do the same, but have managed to generate a higher alpha. So with Quantum's alpha being about 1% since inception, is this the best we must expect in the future too?
The answer is, let me go back in history. When I said the intrinsic value is 100 of a stock, we estimate, and you want to buy it at a 25% discount and buy it at 75, so that we get a 33% rate of return over 2 years, which is 15.5% compounded. There's a logic to that whole 25% and 33% number. And the logic is that if you look at the government long bond, which is a risk-free rate of return in India, you buy a 10-year government bond, you'll get a 7.15, 7.2% rate of return. So let's just, for argument's sake, say it's 7.5%. You compound that over 2 years, right? We're saying we look forward 2 years. So like for like, if we hold the bond for 2 years, 7.5% compounded over 2 years will give you roughly 15.5% or rounded up to 16% rate of return. That's your risk-free rate of return over 2 years, 16%. If you're going to be in equity, and this is where the PhDs come in, they call something called the equity risk premium. Why is it an equity risk premium? Well, governments generally don't go bankrupt. And if the governments went bankrupt in our country, we'd all be in trouble. So the risk-free rate of return is, like I said, this 16% rate of return. And you need to add something to that if you're being in something which is more risky than the government of India. So you're in a private company that's more risky, and it's a stock market stock. It's not a bond by the company, not a debenture, it's a stock. So let's say you add 2% for that every year. You compound that. So you get roughly 4% for being an equity risk premium. That means a 16% of the risk-free rate of return of the government of India. You add 4.5% for being an equity, you come to 20% and change. Now that's the market. And we actually attempt to do better than the market. So we took a round number 25. We said, let's be another 2% over and above the market each year. So you're compounding that and you're getting 4% there. So you come to 25%. That's why if something is at 100, I want to buy it roughly at the number that I said, 25% discount. So I buy it at 75. When I buy it at 75, if you're correct, and it goes to 100, it's a 33% rate of return over 2 years, 15.5%. That is the portfolio. Now, against the index has no cost. It doesn't pay brokerage. It doesn't pay ST. It has no board of trustees. There's no management fee, of course, etc. to an index. An index is 6, 7, 8, 9, 5 people in a gray suit or gray saris, whatever they wear, deciding what should go in the index based on market cap and size. And they don't look at integrity screens. None of that stuff exists. So we're competing against fiction in some sense. Now you can say, okay, fine. Everyone's competing against the same fiction. So where is your alpha? My rate of return is going to be, if we are correct in what we do and demonstrate it, is 14% plus annualized. I don't know what the index is going to do. I showed you during certain stress periods, if you look at this, if you look at her. Now, did the index give me a rate of return of 110% between October and November 2008 and November 2010? The answer is no, it did not, right? But during the COVID period, yeah, the index gave me somewhat similar rate of returns to what we had during the COVID period. So the index may move in its own way, and we don't try to compete with it. But yes, we've already built in buffers in terms of our expected rate of return to be higher than that of the index. Some of it gets eaten away by the cost of maintaining an index. And when you say the peer group, everyone has got their own target, what they want to invest in. We are very clear of what we're trying to do. We're not competing with Fund A or Fund B or Fund C. We're competing with ourselves. We've given you a forecast. We've got, when I say forecast, an estimated rate of return in terms of what we're trying to build in the portfolio, and we're competing against that. We're not trying to be the best fund with the highest return. We're trying to say, allocate your capital, some of it, to the Quantum Long-Term Equity Value Fund, after you've read all the scheme documents and understood all the risk and return, of course. Allocate capital on the assumption that these guys can give you 2 times the risk-free rate of return. That's all that we try to ask for. And you can find someone else who gives you 3 times and 4 times and 5 times, allocate capital to them. You're very welcome. But find that person who can make that estimate and deliver it to you. Not as is said in the SEBI thing very clearly, past performance is not a prediction and should not be used as a gauge of future performance. We're not talking about a past performance. We're talking to you about a future estimate of the NAV. Big difference, big difference.
Thanks, Ajit. Ajit, next question for you again.
I did see one question on the chat group, which, yeah, go ahead.
Yeah, you can go ahead. Which question are you addressing?
No, I was just saying that I did see a question on the chat group, how we pick stocks. But we have a very strong mechanism, obviously. The fact that we have this intrinsic value, the fact that we're able to estimate earnings and make a forecast on it, indicates we know what algorithm. We spent roughly, I don't know, 5-6 lakh hours of human power, of human brain power, to build databases, to meet companies, to understand sectors, not only in India, but understand sectors globally, and try to figure out where these managements, these companies, their integrity, the way they treat minority shareholders, I mean, you name it. We've done a lot of it. And, you know, I really hope that people appreciate that. And I hope that you tell more of your friends about what we're doing.
Sure. So, Ajit, with the anticipated frequent geopolitical tensions in the years to come, would you recommend, higher allocation to gold?
So I don't think gold should be more than, I don't know, I've always said 5, 10, 15, depending on your, like or not for gold. But I don't think you should give a higher allocation to gold in the Indian context for 2 reasons. One is, as Christy indicated, we had the rupee fall by roughly 3.5% over the last decade. I think that sharp decline is sort of over. It'll be probably closer to plus minus 2% for a while. And, for the first time, as Christy indicated in his charts, Indian software exports are more than what we pay for oil. And that's a sea change, because it's always a shortage of currency, which made us worry about the inflation, where interest rates will be to keep the rupee strong. Now, with the flows of foreign money, FDI money, portfolio money can leave, of course. But if you show and demonstrate a commitment to economic growth, and a commitment to equitable economic growth, and a commitment to fair capitalism within this economic growth, foreign money will continue to pour into India. the ratio of China to India is 4 to 1, 5 to 1. So China gets 4 times or 5 times the money that India has got in the previous decade or so. That number is going to change in the favor of India for sure. It may not be that people will give all the money that they're giving to China towards India. No, they may give some of it, but even some of it could bring a doubling of that money. We had done a study about 7, 8 years ago on how much FPI, foreign portfolio money, could flow into India. I'll give you some numbers on that. Currently, we're about $20 in private equity, venture capital, another $10 billion in stuff like infrastructure, etc. $80 billion, rounded up to $100 billion. We believe that can actually double. That India can get $200 billion a year from foreign portfolio flows. To that, you add the infrastructure investments from multinationals in maybe port partnerships and airport partnerships, and then the FDI into building factories. I mean, India's got a fantastic future. It's had a fantastic future since 1980. And 81, when you had the first reforms by Mrs. Gandhi, of all people, 81, 82 on the NRI side. And then in 1990, I wrote an article for the Wall Street Journal saying that the bull run has begun. The index was 500 in 1990, February, when I wrote that article 34 years ago. And there was a Wall Street article recently talking about the great Indian bull run. Well, they're 34 years too late. We've had a phenomenal rate of return over the last 30 years in the Indian stock market. So I'll tell you this, the quantum, so we have an international product value fund, which has the same stocks. The track record of the value fund has been 90% more than the track record of the S&P in dollars, in US dollars, since 2000 over the last 23 years. So 1.9 times the rate of return of the S&P. So foreign investors who not invest in India have missed out over the past 4 decades. And if I was them, I would be rushing into India, rushing into allocate more, which of course leads to a problem of valuation, right? Because share prices go up, etc., and they run up too fast. And then you can also have an issue where bad IPOs come in. And then the whole cycle of bad IPOs, bad pricing, people lose money, they get disgruntled, and they walk out of India. Or governments begin to believe they're very powerful and they can do what they want to do, and they disappoint, like you saw for Russia, China, Brazil, etc., etc. So of the 4 countries in BRIC that Goldman Sachs, touted in 2005, there's only one lone ranger standing. That's India. Brazil's a non-entity. Russia's a non-entity in the investment world, and so is China soon becoming a non-entity. So the only one that's standing is Brazil. Turkey, South Africa were flirting on the sidelines. They've always been on the sidelines and have been sidelined by foreign investors. So, I'm very optimistic on India. I do get nervous about valuations, and I strongly believe that over the past few decades, and now we've given the stewardship of that to Christy and George and other team members. Subbu and I built a process from 1996, and that process has seen so many cycles. And we launched it in the India Fund, Value Fund, in 2006. So it's really seen decades of cycles, and it's tried and tested, if you will. And so, little waves of underperformance. Why have you not done better than your peer group? I have no idea what the peer group objective is. I know my objective. I know the objective of the value fund. How do I make a 15.5% rate of return? As simple as that. And we've shown how we can deliver on it. If the peers have found a way to give you a consistent 18% rate of return, 20% rate of return, all the best to them, and tell me who they are. I'll put my money in those funds if you tell me who they are. And you show me the track record of expecting, predicting, and delivering.
Thanks, Ajit. Christy, coming to you quickly. What do you expect in terms of, the share of equity markets in Indian household savings? How is it shaping up? How's that trend shaping up? And, what do you estimate it to be like 5 years from now? And what are the reasons for that?
Right. It's very difficult to estimate what that number would be. So currently it's around, near about 5% of the total Indian households, household assets. So, if you broadly look at that number, let's say 10-year back, that was close to about half of it, around 2.4, 2.5-ish. So part of the growth is, of course, your equity markets have extremely done well versus the other, assets that the household might own, which is property. So around 50% of Indian household is owned by, property. They own property, and a significant other chunk would be gold. So compared to these assets, of course, the equity has done well. So part of that growth is essentially due to how the markets have done. But what we are seeing through our SIP numbers running around $2 billion per month, and so much of flows coming through EPFO, NPS, which is again retail funded. So we have seen an increased equity participation. Uh, so, you know, I think if you look at any global market, the equity contribution over a period of time increases. I was just looking at mutual funds by in US, they are roughly in 2004, it was around near about 14-15% of the total, household allocation. So that's a fair, that was in 2004. Now it is somewhere, 5% or 6 percentage point higher. So the way is of course going to be up. And there are some easy picking. So if you look at Indian household allocation to bank deposits, it's almost 3x of your equity allocation at around 15%. So as people are going to get more educated, look at yields, what a bank is offering, especially not so great SAR deposits, people are going to move to equity in some or the other way. So that 5% will be probably going up in the years to come, but very difficult to pencil in a number.
Thanks, Christy. Ajit, can the strongman?
Ghazal, can I take?
Yeah, sure.
Yeah.
Go ahead.
No, sorry, go ahead. Can the strongman?
Can the strongman phenomena happen in India too? The political conversation is poor now. The opposition appears bankrupt. Your views? Ajit,
And there's nationalism and there's
Yeah.
strongmen, right? So Singapore had leadership and a strong man in Lee Kuan Yew and had this national pride. So there's no harm in strong men being there per se. But then you look at Xi or look at Putin or look at Erdogan, you have strong men who've done things that are hurting not only their country and the community of investors, but also the world. So just being a strong man is not a bad thing. Just having that strong man title is not a bad thing. It's what you do with that power. It's what you do with, there have been kings who have been wise, there have been emperors who've been wise, and there have been kings and emperors who've slaughtered their people. So just having that title per se is not bad. It's something that we look at India's at anywhere close to where a Putin or a Xi is. We don't believe that at all. But it's something that we like to look at all the time, and that's what we like to share it with you. These are things that we try to understand as to what's happening in the world. Where does India fit in? Where does the government fit in? Because we've come from an economy in the 1970s and 80s where you could not leave the country with more than $8. We've come from a thing where to wait 3 years to get a phone connection. We've come from an economy where you had to wait 12 months and 18 months to get a two-wheeler or a car. And the big thing at the Times of India matrimonial ads, for those who remember that, I don't think Ghazal, you or even Christy would remember those, of course, but there were ads in the Times of India which basically said that either the boy has to have a green card, so I can send my daughter out of this horrible country, or you better have a booking for a Bajaj two-wheeler or a Fiat car, because at least my daughter will have some luxury to live in when she gets married to you. So we've come from that India. No one wants to go back to that India. No one wants to go to an India in the India of Indira Gandhi, where you had the emergency, where you can't talk, where you can't speak. You don't want to go to it. You don't want to be a Russia like India, where Putin can take away money from one oil czar and give it to some other oil czar. We don't want that. We want a freer society. So I think we're there. I don't think we're not there for sure. So we're fine. But it's something that we should look at. We should track. 100%. You should never take anything for granted, right? You you've had revolutions in India, good revolutions and bad revolutions in India, right? So never take things for granted.
Ajit, the conservatively managed.
I did see, if I may jump in, I did
Yes.
see some question.
Go
Yeah.
ahead, please.
Sorry, I'm just going to jump in because I did see some comments on the future of quantum AMC. What's the vision?
Yeah.
Well, the vision is if there are, I don't know, 40 lakh people with mutual funds in India, I don't know why those 40 lakh people with mutual funds are not putting 5% or 10% or 20% of their equity value allocation into quantum long-term value fund. That's the first puzzle. I mean, I sort of know the answer, but and the answer is not because my performance against fund A or fund B or fund C is poor. That's completely the wrong way of looking at us, totally the wrong way. But that's the way we've been trained to look at. You have the rating agencies with their 5-star, 4-star, 3-star, 2-star. You have the distributors who will only sell the funds that are either hot or the funds that have got high fees or high commissions. You have the wealth advisors who are supposedly looking at funds differently. We haven't seen that as yet in my approach with many wealth advisors. They end up with the same garbage nonsense of alpha, risk return, your what they call gateways of alpha to the group. Alpha, they talk about certainty. I tell them, I said, certainty. Look at this chart. I mean, I would love people on the chat group or listening to please put down the name of any fund house where they've made a forecast 2 years out, an estimate 2 years out, and then shown it to be this close. Please, I'd love to get those responses on the chat group and to see which are the fund know of any fund house in the world. Let me know. We're unique. We're an absolutely unique entity in that sense and a unique product. So the vision is that people will understand that uniqueness. We're doing our best by trying to go into webinars, explain people what we do and showcase what we're doing. And we hope that people will pass that along. The other question that came on was about Quantum's FOMO of having a small cap fund. Did we launch a small cap fund because we felt we were missing out? Well, we launched the long-term value fund in March 2006 when the index was at a peak, at a then peak. There was no fear of missing out. We had a product, we had a license, we had a process, and we brought that to the table in a very similar way after nearly 10 years of trying to figure out how we should build a process-driven small cap fund portfolio. We figured it out, we think, and we built the portfolio structures, built the research databases, and launched the fund in November of 2023. It so happens that it is the then peak of the small cap index, and the continued peak is still peaking every week. So will the small caps correct? They should correct. When will they correct? I have no idea. But the key is, just like the Quantum Value Fund, which was launched in March 2006 at the peak, and then by June, July of 2006, the markets became more rational, and Quantum was able to shine and show how its rational process, its rational approach to investing outshone, in some sense, what the peers were doing. So I really don't want to compare ourselves to the peers or the index, but since people want some benchmark, and you have to look at a benchmark, I say, look at my expectation and tell me if we're meeting it or not. Are we giving ourselves the 15% gross return or not that we indicated we would when we said intrinsic value 100, buy stock at 75, and if you're sensible, you hold it for 2 years or longer, you make an annualized return of 15% per annum. Really as simple as that, nothing too complicated.
Ajit, quickly to the next question. A conservatively managed multi-asset fund of fund has seen its appeal go down because of the taxation change. How do you plan to provide a tax-efficient, conservatively managed asset allocation product?
Sorry, repeat that again.
The investor is asking if we have plans to provide a tax-efficient, conservatively managed asset allocation product since the fund of fund now has lost its appeal because of the taxation change.
Yes. Yeah, correct. Correct. I'm sorry. Yes. So there is a filing for a multi-asset, a flexi cap fund or whatever it's called, in lieu of the multi-asset fund, which was there before. Very sad. A great product, but one stroke of the pen on the taxation side makes the product, less relevant to many investors because it's now under adverse taxation in some sense. So yes, the answer is there is something coming out, but Quantum doesn't launch funds for the sake of launching funds. We don't have a FOMO, fear of missing out. It's all within that initial triangle that I indicated, which you saw in the asset allocation. We don't believe you need to have 50 funds to get what you want. We believe literally a sample of 10, 12, 14 mutual funds at best. And within that, within the allocation, you'll be fine. We have a dozen funds out there who are sprinkled across this allocation. And the multi-asset fund would be a great fit. We had an equity fund of funds. Even that is under a bad taxation environment. So, those things will happen, but we're not going to launch 20 other funds. That's not what we do. We're not an asset gathering company. I keep on saying this. We got an AMC license, asset management company license, not an asset gathering company license. So if we know how to manage a pool of money, we launch it. We know how to manage capital a sensible way, we launch a product. We're just not going to do it because it's a thematic and it makes sense because the world wants a crypto fund or they want an infra fund. We're not going to launch this all the time. We don't understand that stuff.
Thanks, Ajit. Christy, coming to you, there seems unending liquidity in the market. Do you think there will be any meaningful correction? If not something like 2008, are we looking at a time correction?
Yeah, that seems to be what it is, but one really can't rule out some of these big corrections because you never know until they happen. So, if you look at the broader FMCG index, which is, was dearly loved in the sense like in 2018, 19, valuation, peak valuations, and so on and so forth. Now, what you're seeing a significant time correction. Now, these were supposed to be the quality names within the whole basket of whatever is there in India. So if you pay exorbitantly, you see that correction. Now, given the nature of the business, there is, it's not a big correction that you see perhaps in 2008 and so on and so forth, but there is correction. And another point that I want to add is, we are looking at a significant kind of a different world from 2014 to 2020. I would say post GFC because there is significant cost of capital now, which was absent earlier. So people are going to look at valuations in that context. When you're looking at valuing a company at 2%, with interest rates versus now at 4%. So, that takes a hit in terms of valuation, especially in some of the growthy names. So there is going to be valuation consciousness across the market, and possibly it could be time correction. The big correction, you can never time it, and you never know, in fact.
Sure. And Christy, we've been reading about how private capex should follow public capex. When do you think that revival will, come about? Like, what do you see on that front?
Right. So, what you've seen is like the private capex been absent for a very long time, and especially from you look at 2012 onwards, that private capex has never really picked up in a big way, and especially 2014, 15, that era, until when the banking system had an issue. So the corporate, lending has freezed. If you look at a public sector bank trying to lend to a corporate because of what they have done in the past, most of the NPAs were recognized and nobody was willing to lend to the private space. But now that seems to have corrected, and we also see an appetite from from the private companies, because most of them are seeing utilization level hitting new high. And of course, if you put capital to work, there is significant demand, so there is certainty on that front. And from our conversation with a lot of the banks that we meet, they are also hopeful that some of that number in the corporate books kind of should pick up incrementally. One data point that I want to share, because RBI kind of releases this almost yearly, the total bank sanction to, the private enterprises, it includes the bonds, the external commercial borrowings, and the bank sanctioning to them. So that number was in August of 2023, it was at 11-year high. which tells you that most of those corporates are going to, that capex activity is going to perhaps start in the year to come, or but it's like this, if a private guy decides to put up a capex, first he has to make investment in land, he has to put a company, he has to get all the machinery, so it takes some time. And so far most of that capex is being funded internally, because post covid you're all surplus sitting with cash, right? So when that wanes out, they're going to come to the bank, and you should see that private capex pick up, in the medium term.
Thanks, Christy. Ajit, what are your comments? Yeah. Would you like to add
Ghazal, can I
something?
just jump in?
Yeah.
Sorry, Ghazal, can I jump in, please? While you were interviewing Christy with the question, I scrolled down the chat group a bit, and I saw a comment that bring Ajit back, because while he was there, Alpha was better.
Yeah.
Well, the secret or the unknown fact may be my last research report that I've written for Quantum Long-Term Value Fund was in 2007. So I put this chart up here, 2007. So everything that has been built in terms of the research databases and in terms of the portfolio construction was after my last research report, which happened to be Infosys, by the way, since 2007. I've not done research. And research is a raw material for everything we do. So for those of you all who have the notion that bring Ajit back and the fund will perform better, well, actually the fund has done fantastically well, because it's done what it's supposed to do since 2006. It was designed for this. It's a BMW. You buy a BMW, you expect it to do something. It's great engineering. Quantum, without any algo, without any, someone mentioned quant, and yes, we have issues with someone copying our name. That's another discussion altogether. But it's a great engineering that we've done. And yes, Subbu and I worked on it together. Subbu's the one who's been slogging over the last decade and a half, training more people in quantum to, after our brains have long faded away. We hope that the next generation of the fund managers will be smarter than us for sure, or they would not be hired otherwise, and they take it forward. So you don't need an Ajit or a Subbu around to deliver what we've delivered. It's there, it's running. The BMW is working beautifully. All right. So please don't go back to, yes, I'm probably the most vocal. I probably get the most excited. I'm probably the loudest speaker in the room when I'm from Quantum, for sure. But that's only because I talk too much and don't do work. The hard work is done by others, and you can see it on this chart right there.
Thank you, Ajit. Ajit, coming to this question on your comments on, the 2 or 3 star fund ratings by, leading publications for QLTVF. What would you say to that?
The 2 or 3 star ratings that we get, like I said, they look at 1 year, 2 year, 3 year, 5 year, 10 year. And, it's useless. I mean, to me, that's meaningless. It's a calendar year number. It's not a market phase number. So it's meaningless. But that's the way. It's easy. It's more difficult to look at data. And for those who want to see how fund research should be done, please look at Personal FN. Personal FN does mutual fund research. It's one of the companies that Subbu and I founded decades ago in 1999. And look at how they do fund research. And look at their ratings, and look at how they look at quantum, for example, versus other funds. And look at other funds versus the other rating funds. I want to touch upon one more that came in, which said, let's see how they perform when the AUM goes up. It's a fantastic question. And we have an answer for that too. Like the BMW, right? BMW has a capacity. This mug with quantum on it has a capacity. This Dettol has a capacity. My phone, Samsung phone, has a capacity. Everything has a capacity. The screen you're watching has a capacity. Everything's got a capacity. And our question to SEBI and to other fund managers for decades has been, why are fund not announcing their capacity? Okay? When you research a fund, when you buy a BMW, if you don't call up BMW and say, your factory makes 1 million BMWs, which BMW did I get? The first one, the 100th one, the 1000th one, the 1,000,000th one? You don't ask that question. You just buy the BMW because the million cars are going to be produced exactly the same way. The steering wheel in the right place, you push the button, the engine will start. You know it's going to be perfect. Same thing with the fund. We have a capacity. We calculate our capacity. And what is capacity? Our capacity of this product is roughly 70,000 crores. 70,000 crores. We're today at about 1,000 crores. If we got tens of thousands of crores, the same track record that you're examining, the same BMW that you examined in the showroom, and you press the starter button, the wiper, the rubber, the steering wheel, the quality, you'll get the same portfolio to 70,000 crores of AUM. We calculate our capacity every day if you want it. And no one in the fund industry does it. That's why you today have small cap funds who are holding illiquid stocks. We have a liquidity criteria. When we buy a share, we say we typically hold it for 5 years. We value on 2-year basis, but we change our assumptions on companies as they announce results. So kind of a rolling 2-year number on that integrity, the sort of intrinsic value. We typically own shares for 5 years. 5 years is 60 months. If we hold something for 60 months, in our portfolio, we allow ourselves 5% of the time, that's 3 months, 66 trading days, to deploy capital into that stock or take the capital out of that company without having much of an impact on the share price, because the share price is part of the net asset value, which should be a transactable NAV. What you see on the NAV is what you should get. And we have a rule, and the rule is 90% of the portfolio, if every client wanted to sell on the same day, 90% of the portfolio must be liquidated within 66 trading days, right? And the capacity is defined as when you have 10% of the portfolio where it takes more than 66 days, then your capacity stops at that number. And as of today's daily volumes, as of today's AUM, you have to give me a check of another 70,000 crores before I worry about that. So again, people don't understand fund management. The rating agencies have never asked any fund manager, what is your capacity? They've never asked us, tell us how you perform over phases. They've never asked us for prediction and estimates of the NAV and how have you done. They look at exactly what SEBI tells you not to look at, the suckers in the past performance database. That's what they tell you to look at. And people listen to that. And y'all are all being led down that garden path. So there's an investor education fund, but they've not told you about estimated NAV. They've not had upside potential. They've not taught you capacity. They've not taught you about risk-free returns and how a fund manager determines something. They talk statistical garbage, alpha, gamma, rubbish, total rubbish in my view. But that's my view. And we are, as you know, very focused on making sure investors make sensible allocations. And that's why we make that the triangle and tell you where you could allocate your money, and where we can add value, we'll add value. Where we don't have value, you won't find a product and you can go and buy someone else's fund.
Ajit, we also received one question online. What is the implication of unprecedented debt levels on global economy?
So that's a big one, right? I mean, if you think about all the debt that has been taken off, from the Lehman crisis, we had the debt, which was small. And then you had COVID, which was a massive social issue and health issue. And the debt in every country has just gone through the roof. This is separate from debt for real estate companies that didn't do well, or companies that took money and stole money, separate from that. But the GDP debt around the world is ballooned. And much of this debt was taken when interest rates were 0.5%, negative interest rates in the Eurozone, in Germany for a while, in Switzerland, and now the rates of interest have crept up. And every study indicates that the governments will be unable to pay much of this debt if interest rates kept on increasing, which is probably one incentive why they need to bring interest rates down. They're all waiting for inflation to steady off a bit so they can bring interest rates down. and then the interest cost in the budgets of every government will start reducing again. So it's only been high interest rates on high loans for about a year. And I don't think any government can withstand high interest rates for too long, given the debt that they have. This may be linked, Ghazal. I know you love gold and you manage gold and you do a great job of it. And your question about allocating more to gold. So, by you look at most people, they'll tell you gold should be $3,500 an ounce, $4,000 an ounce. Some will tell you $5,000 an ounce because of that monetary crisis and the fiscal crisis that's there. I don't have an answer. I don't have an answer to how governments will get out of it. They can't tax more because taxing will slow down GDP and bankrupt a lot of middle class and lower income people. They can't cut rates too fast because inflation still exists. And what you're seeing in the Middle East will also add to inflation. What you're seeing between Russia and Ukraine and other stuff is still keeping inflation high. But China's doing stuff that will not reduce inflation either. So I don't have an end result, and which is why going back to your goal question, I'm still comfortable with 5, 10, 15% of gold in the portfolio as a hedge. I don't have an answer, but it's a huge problem.
Yes, yes, Ajit, it is. Christy, one question for you. Which sectors are you bullish on, post the election?
Right. So as I alluded to, we expect the private capex to kind of pick up in the medium term, and linked to that, we are positive on a lot of banks, especially the wholesale, funded banks, in the sense they have some way to go, because in a way we have not seen that in the past 10 years. So, and if you look at, most of those banks are available at fairly decent valuations. So banks is a big sector that kind of we are overweight in. To some extent, so that is just linked to, post budget. It really doesn't matter like whether it's post or now. I think most of that will kind of play through over a period of time. The other kind of sector that we are kind of positive on is, of course, IT services. We have been bullish on it for quite some time, and I think now slowly we are incrementally hearing about the demand pickup slowly happening in the developed world. You can't. IT spend is not really so discretionary as everybody thought it is, because at a period of time, this is most of the banks would have to invest, which are banks are typical clients of all the IT services banks. Around 30% of the revenue mix comes from international banks. So in that sense, they cannot postpone tech spend for far too long, and we should see that growth. Some of it is already happening. So those would be two main sectors. Auto also, but auto slowly we are kind of trimming our allocations as some of those pieces that we had envisaged are playing out in terms of volume recovery, and the valuations have also caught up quite significantly in the past 6 months.
Also, question, what are, the direct or indirect impacts of, an extended geopolitical conflict on Indian equity markets?
Right. So the crude solution, while I did show that in the chart in terms of your ID, export services kind of going above crude, the oil imports in that sense. But crude is a significant, we are kind of really dependent on that. So from a geopolitical perspective, how that crude moves in the near future is going to be quite impact, because high crude has a indirect impact of slowing down the economy, because you have the whole logistics space linked to that. While it may not immediately reflect in companies' earnings, but it does have that inflationary impact as the crude goes up. Some of the things that we are hearing in, especially with Red Sea, those could have possible implications. I'm just, speaking of points apart from the high interest rate and so on and so forth, which Ajit addressed already. But, we don't know how that would settle in, because bulk of the world cargo transport happens through that. And slowly we are hearing of some companies reporting, at least in their, con calls, that there could be some delays. How it extended it could be, that's anybody's guess, and it's with respect to what happens there. But some of these impact can play out in the earnings of most of the companies that we look at, especially some of the export facing auto names would be susceptible, the chemical names, especially folks who export to US or Europe might be impacted by that.
Thanks, Christy. I think I'll take one final question for Ajit before I ask for your closing remarks. Quantum has stayed away from strategies like arbitrage and covered calls, which other fund houses are actively using. What's your take on that, Ajit?
So, you know, we haven't done that. And I don't know if we ever will. It's a niche in some sense. Within that triangle, if you look at the liquid fund, it's not an FD. There was a comment on that. It's not an FD. There's no guarantee like a bank. If a bank goes bust, there's a 5 lakh rupee guarantee. There's no guarantee on that. You're buying government bonds. Governments can go bankrupt. But we haven't done anything else on that spectrum. Will we ever do it? May or may not be. I think that sounds like more like a quant strategy. A lot of people spoke about quant on the email. That is confusion. It's a very different approach from our way of investing and thinking. The quantum is not a quant house. Yeah. And we haven't really done anything which is unusual from the methodical value investing and the equity side, right? We don't do anything different from that. Will we never do it? No, we have very smart people at Quantum AMC. One day someone comes up with a good idea. It goes to the investment committee. They like it. Yeah, they say, great, let's set up a fund for sure. But I don't believe it's on the horizon at this stage.
All right. Thank you, Ajit, for that. And with that final question, I think I will conclude today's discussion. Any closing remarks from Ajit, Christy?
I've said a lot of closing remarks. Thank you very much to everyone for listening for 2 hours pretty patiently. Really appreciate that. We do have a lot to say. We have a lot to showcase and a lot to discuss. And there was a nice discussion with unit owners. Actually, we do. We have something called Path to Profits. And the Path to Profit is like goes around the country. And we talk to people for hours on how we pick stocks, on the process of the value fund, etc. for hours. I don't know if you have any good sort of YouTube video for those. Thank you again. Thank you. Thank you.
Thank you, everyone.
Thank you, Christy.
Thank you, Ajit. Thank you, Christy, once again. And thank you, everyone, for joining. Good night.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.